global economy is clearly slowing down on a rate of change basis. Even the labor market, which is often depicted as extremely strong, on a rate of change basis, the pace of full-time hirings in the US has declined pretty aggressively since the top, which was in summer 2021. So we are still hiring on a net basis, but we're slowing down the pace of hiring. Any other measure that looks at real growth has actually on a trending basis come down pretty aggressively. Think of the volume of retail sales, for example, because as prices have gone up, people look at nominal retail sales. But if you look at the volume of retail sales and the growth there, it has also slowed down pretty aggressively. And earnings are also slowing down. We have seen Amazon reporting negative surprise on earnings, Meta, other companies. So I guess we are entering now that phase of the economic slowdown, which becomes more evident, more pronounced in indicators where people are more familiar with the real hard data rather than the survey indicators that we saw dropping very aggressively in the first half of the year. So we have seen the first negative core CPI surprise in the US last week, where inflation came in on a month-on-month basis at the weakest level since summer. Now, I expect core inflation to print between 0.3 and 0.4% month-on-month between now and June. It's a slowdown in pace compared to what we had finally, but it still makes for annualized core inflation over 4.5% by summer next year. That's going to make the life of the Fed a bit difficult when it comes to pivoting very hard. They're going to be very patient. They're going to wait for inflation to really come down, which I do expect to come down very aggressively, but late 2023. So there's going to be this transition period between now and then. Mechanically speaking, Adam, it's almost impossible for core inflation to slow down to annualized levels below 4% between now and June. And the reason is simple. Core services inflation is a large component of core inflation overall. And core services are very lagging indicators and mostly dependent on rent of shelter. So rents are coming down on the ground. They're cooling off on the ground, negotiated rents are. But because the accounting of this rent inflation within the core inflation basket is delayed effectively for accounting for technical calculation reasons, it's going to take at least another 5 to 6 months for this cooling down of rents to be visible in core inflation. So as that is the case, mechanically, even if goods become cheaper, and they are in a disinflationary trend, it's almost impossible for core inflation month-on-month to drop below 0.4% sustainably between now and June. What happens after that, though, is that the pain in the housing market, the pain in on the ground real rents being negotiated today will be reflected as well in core inflation in the second half of next year. And as the economy slows down, the labor market slows down, earnings comes down, that will basically compound the situation. And I expect core inflation to end 2023 at or below 2% on an annualized rate of change. And that's an out of consensus goal. That will mean that the Federal Reserve has already achieved their target by end of 2023, beginning of 2024. Now, the problem with that is that to achieve their target, they have generated a recession too. So there is nothing to be particularly happy about this achievement of targets. I expect unemployment rate in the US to be at or above 6% by the end of next year. And we have seen some debacle in the crypto market. We have seen big deleveraging in the Chinese real estate market. We have seen some pain being generated already in the housing market in the US, where sales volumes are 70% lower than last year. Basically, there is no activity anymore. Nobody is doing any transaction anymore in the housing market. It's a complete freeze. But it's not a disaster yet. The rates that economists can take, also known as neutral rate, is basically a rate which is driven by population growth, productivity growth, and the amount of debt into the economy, roughly speaking, right? So the US has a labor force growth, which is a tiny bit positive year after year, not much fertility, population growing older, some immigration to offset. Labor force grows a little bit every year. Then there is productivity on top, also grows like maybe we become a bit more productive year by year, say 1% productivity gains every year. And, you're looking at the real equilibrium rate of maybe, somewhere, if you put all together in an economy with 400% of private plus public debt GDP and relatively weak labor force growth and productivity growth, this neutral rate in the US is maybe in the 2.5-3% area. Any reasonable estimate is roughly there. 5%, it's double that neutral rate. But it's not a coincidence, because last time that inflation was very, very high, both in Europe and in the US, nominal rates had to be double the neutral rate, 300 to 400 basis points above in the 80s and in the 90s. Today, double means 250 basis points above the neutral rate, to make sure that the economy suffers enough, slows down enough, that things become complicated for us, that getting a mortgage is nearly impossible. It's unaffordable. Corporates levering up their balance sheet becomes prohibitive. So companies will stop spending on capex, will hire less, will slow down. It's all designed on purpose to make sure that the economy slows down and that inflation slows down too. I think the Oppenheimer shock is already here. It's all about when the patient is gonna die or be very close or go into coma effectively, and we're looking into that in 2023. I mean, what I want to say on, for example, the labor market is the following. Right now, we have seen some large companies announcing hiring freezes and or the initial cuts. Amazon today, it's the first announced 10,000 layoffs just to start. Meta has announced layoffs. We're seeing layoffs, especially in tech companies, being announced in very large amounts and very concentrated. Normally, these layoffs are not one-offs, Adam. They start and then follow a cycle. And if you look at, for instance, what happened in 2001, now what happened in late 2000 and early 2001 reminds me very much of what we're facing today. We're facing earnings slowdown. We're facing companies starting to cut jobs because they can't cover their costs anymore. The economy is slowing down, their revenues are slowing down, and therefore they start cutting more core items of their balance sheet, like labor. That's what we're seeing today, a very similar situation to 2001. So the first thing it's telling us is that inflation is going to slow down according to the bond market. That's the prediction. So today, inflation rates are almost 8% in the US. And if I look at what the market is pricing in 1 year to 1 year and a half ahead, Adam, in inflation market, in inflation swap market, we're looking at inflation swap rates of 2.7%. But in general, if you look at the slope between a 2-year or 10-year government bond, effectively, it's been a 90% reliable indicator of a recession. It's the bond market telling you, yes, Federal Reserve, you can push 2-year rates higher. You have control on these rates because those are short-term rates. They're highly influenced by your Fed funds, by your Fed policy. But the bond market, looking at 10-year rates, is discounting what the future growth and inflation will be, not only for year 1 and 2, but for year 3, 4, 5 until 10, which is basically the result, Adam, of your policies today being reflected in the future. And if you become too tight today, then you're going to generate a recession and a disinflationary recession, which will get priced in the long end. And effectively, the bond market has been always right. When the bond market thinks that the Fed is doing too much, it inverts the curve, and almost punctually over the last 50 years, a recession has unfolded. So you're asking me, when are people going to start losing their job? When non-farm payrolls are going to turn negative or flat? So we're not adding jobs anymore into the US economy. We are at margin even cutting them, right? And I expect that to happen somewhere around April next year, roughly. The US housing market accounts for 15 to 18% of US GDP and employment, if you account as well for ancillary activities around the housing market itself. And I'm talking about the brokers, construction workers, furniture shops, and so on and so forth. Now, that's roughly 12 to 14 million jobs in the US. Now, if the market is completely frozen, Adam, and you do not do any transaction, you do not build new houses, you do not change house, and therefore you don't need a new painter, you don't need new furniture, etc., etc. Marginally speaking, there are not going to be any new jobs created there. On the margin, they're going to be cut, especially the jobs that were created on the hype of the real estate market boom in 2021. If only 15 to 20% of only this sector as a job is cut, so only the excess basically streamed off the real estate ecosystem, basically as a job, that means roughly 1.82 million jobs are at risk only in real estate or ancillary activities, right? Now, 2 million jobs in the US, you need approximately 100,000 jobs to be created every month just to keep unemployment rate stable. That's the mathematic. Now, if you're cutting 150,000 jobs only in the real estate market, only there, and you're assuming that there is no job loss anywhere else, you are basically already at risk of turning into negative non-farm payroll. I guess the housing market and the housing related jobs are going to be negative next year, but they're not going to be the only one to suffer. So if you make a base case there and a base case in other sectors as well, you are very likely to end up with flat or negative non-farm payrolls by April, May, June next year. And negative non-farm payrolls is people losing their jobs on a net basis. That's effectively the definition of a recession.